A global rout in government bonds is starting to sound market alarm bells. US Treasuries have joined equities in selling off this Wednesday as widespread US tariffs take effect. Yields on the 10-year hit 4.49% briefly overnight, dragging borrowing costs higher around the world. Long-dated bonds have been the focus of intense selling from hedge funds, while at the same time the dollar fell against the euro and the yen. Chris Turner is Global Head of Markets Research at ING. Chris, these US bonds are usually the safest of assets in risky times. How would you interpret this fall?
Yes, it's starting to look a little worrying, right? Because I think over the last week there's been lots of focus on whether the US, the dollar and treasuries remain the world's safe haven go-to sort of asset class. And I think particularly the change overnight in what's happened to US treasuries is starting to look a little worrying. We had thought that could be the risk, and I think the catalyst for that perhaps we'll talk about is we've got US Treasury auctions this week, and that could be a sign where you can assess investor demand and perhaps look at foreign interests as well in US Treasuries.
And what are you expecting from that? Do you think that foreign owners are increasingly deliberately moving away from all US assets?
It's very hard to see at this point. I think people normally will look at what's called the tick data, which is released monthly with a big lag, and that would show whether major foreign holders of treasuries have reduced their positions, e.g. sort of China, Japan, or whatever. But there are also some sort of smaller kind of short-term metrics. So, for example, in the treasury auctions, people look at what's called the indirect bid. So outside of the primary dealers that would take down the auction, what indirect bidders were there? And that was seen as a community where foreign central banks would show up. So low indirect bids are perhaps a sign that foreign central banks aren't as buying as many treasuries as normal. And then also as well, on a Thursday evening, we get what's called the Fed Custody Holdings Report, where we can see the amount of treasuries that the Fed holds in custody for foreign official accounts. And if that starts to drop as well, that could add some evidence to the sign that foreigners perhaps are on buyer's strike or perhaps seem to be reducing some of their treasury holdings.
We also saw the dollar move lower overnight against the yen and the euro. Is the trade disruption hitting confidence in US cash as a safe haven?
Yeah, I think it is starting to be the case. I think in terms of the conviction calls of what's happened over the last week, so global trade war, obviously retaliation, terrible news for global growth, global trade volumes, potentially shrinking according to the World Trade Organization this year. That's bad news mostly for emerging market currencies. And with the Fed not ready to run to the rescue yet because they're still looking at the trade-off between inflation and kind of growth, risk assets are under pressure. And so the yen and the Swiss franc, backed by large current account surpluses, they are proving the go-to currencies. And the dollar's trading somewhere in the middle. So we haven't quite got to a full sell America, sell the dollar moment at quite yet. But I think we will be closely looking at particularly the underperformance of treasuries to see whether a broader sense of dollar selling is about to come through.
What might happen then, Chris, if bond markets and exchange rates form part of trade talks as countries negotiate to try and get these tariffs dropped? The US, for example, wants Japan to guide the yen higher. Its finance minister has said that might be on the table. But what impact might that have?
Yes, this view kind of references this Mar-a-Lago Accord, which has been in the markets for the last, I would say, 4 to kind of 8 weeks. The idea here, the US, first of all, step one, introduces maximum tariffs, then use that as leverage to get the likes of Japan, China, and Europe on board to strengthen their currencies, weaken the dollar, and provide a better chance for US kind of manufacturers. I think the problem, though, with that is that compared to 2018-19, when the US was supported, the domestic economy was supported with a big tax cut, there hasn't been that protection now for the US economy from tax cuts. We've only seen the bad news come in. And actually, probably the weaker dollar isn't helping the US economy right now. The assumption had been probably in Washington that the dollar would strengthen on tariffs and provide some insulation for US consumer from these tariffs. But actually, the US economy is weakening more quickly than they'd expected. I think from all of this, we'll probably take the view that the conviction is growing that the dollar will be weaker in 2026, but I think it's going to be sort of very volatile, particularly in the second quarter, if, as we say, tariffs stay in place, there's retaliation, the Fed isn't able to come in with early kind of rate cuts, I could see the dollar sort of bouncing around in volatile ranges and then ultimately falling once the Fed comes to the rescue and delivers a more aggressive easing cycle.
That was Chris Turner of ING. Don't forget you can watch more videos on Reuters.com.